In early 2021, a digital collage by the artist Beeple sold at Christie's for $69 million. By mid-2022, the floor price of top NFT collections had collapsed 80 to 90%. By 2024, daily NFT trading volume had fallen from a peak of over $700 million to under $20 million. The retail speculation cycle was brutal and predictable. But here's what the headlines missed. Underneath the price collapse, a set of institutional use cases for NFT technology had quietly continued to mature. Major sports leagues, concert venues, luxury brands, and enterprise software companies kept building NFT infrastructure, not to speculate, but to solve specific problems in digital ownership, access control, and provenance verification. In 2026, the question is no longer whether NFTs have value. It's which applications survive the speculative purge and which ones are building durable enterprise adoption. This video answers that question. An NFT, non-fungible token, is a blockchain-based record of ownership for a unique or limited digital asset. Unlike fungible tokens where each unit is interchangeable, each NFT has a unique identifier that distinguishes it from all others. The key institutional insight is that NFTs are an ownership infrastructure layer. They solve the problem of proving who owns what in digital environments without requiring a central authority to maintain the ledger. This makes them applicable far beyond profile pictures and digital art. Tickets that can't be counterfeited. Gaming items with verifiable scarcity. Supply chain certificates with tamper-proof provenance. Academic credentials that can be verified instantly. The technology is the same in all these cases. A cryptographically secured, publicly verifiable record of ownership that lives on a distributed ledger. The speculative bubble was about price discovery. The durable use cases are about infrastructure. The NFT market data tells a story of two distinct phases. The speculative peak in January 2022 saw over $17 billion in monthly trading volume, driven almost entirely by profile picture collections and digital art speculation. By Q3 2024, monthly trading volume had collapsed to under $400 million. Floor prices for even blue-chip collections like Bored Ape Yacht Club fell 90% from their peaks. But enterprise NFT infrastructure tells a different story. Ticketmaster processed over 60 million NFT-based tickets in 2024. Nike's Swoosh digital collectibles platform generated over $185 million in revenue. Soulbound token implementations for academic credentials are live at over 400 institutions globally. The speculative market effectively died. The utility market, quieter, slower, and less glamorous, is growing at 40% annually and attracting enterprise capital from companies with real revenue models. The clearest way to understand the NFT landscape in 2026 is to separate speculative NFTs from utility NFTs. Speculative NFTs, profile picture collections, generative art, virtual real estate, were priced entirely on community sentiment and social status signaling. They had no cash flows, no utility, and no underlying business model. When liquidity dried up, prices collapsed and most collections became worthless. Utility NFTs solve a specific operational problem. A ticket that can't be duplicated, a game item with verified scarcity, a supply chain certificate that proves origin. These assets have intrinsic value tied to the function they perform. The distinction matters enormously for institutional due diligence. An allocation to a speculative NFT collection is indistinguishable from gambling. An investment in NFT infrastructure, a platform, a protocol, or an enterprise application, is a bet on technology adoption with identifiable revenue drivers. Even for utility-focused NFT applications, institutional investors face meaningful risks. IP and copyright risk is the first concern. The legal status of NFT ownership relative to underlying intellectual property rights remains unsettled. Buying an NFT does not automatically convey copyright over the associated artwork or media, and courts have ruled inconsistently on this. Platform risk is the second concern. Most NFT markets depend on centralized marketplace infrastructure like OpenSea or Blur, which can be shut down, blocked by regulators, or exit the market. Third is smart contract risk. NFT contracts are immutable once deployed. Bugs or exploit vulnerabilities cannot be patched without migrating to new contracts, creating operational fragility for enterprise deployments. In 2022, Ticketmaster partnered with NFL teams to pilot NFT-based game tickets for select playoff matchups. The program addressed a long-standing problem in event ticketing: counterfeit tickets, scalper-controlled secondary markets, and the inability to track real fan engagement. Each NFT ticket carried embedded transfer rules that allowed teams to cap resale prices, verify original purchases, and build post-event digital memorabilia into the ticket itself. By the 2024 season, the program had scaled to over 30 NFL teams and expanded to NBA and MLB partnerships. Ticket fraud rates in pilot programs dropped by over 80%. Secondary market resale data, previously invisible to teams, became accessible in real time. The case demonstrated that NFT utility in ticketing isn't speculative. It solves fraud, enables revenue capture on secondary sales, and builds direct fan relationships, all measurable business outcomes. Institutions evaluating NFT technology exposure in 2026 should apply a structured screening framework to separate durable utility from residual speculation. Step 1 is use case validation. Does the NFT application solve a specific, measurable operational problem that cannot be more cheaply solved by a traditional database? If the answer is no, the NFT layer is cosmetic and likely fragile. Step 2 is revenue model analysis. Is there a clear, repeatable business model tied to the NFT's function rather than secondary market appreciation? Step 3 is legal and IP review. Confirm that the ownership rights conveyed by the NFT align with the legal framework of the underlying asset. Step 4 is platform dependency audit. Map the infrastructure dependencies of the NFT application and assess what happens if any centralized component goes offline. Institutional NFT mistakes cluster around 3 patterns. First, conflating NFT price performance with NFT technology adoption. The collapse of speculative collections says nothing about whether NFT infrastructure is valuable, just as the dot-com crash said nothing about whether the internet was valuable. Second, assuming NFT ownership conveys copyright. This misreading has led to expensive legal disputes and reputational damage for brands that built marketing programs on NFTs without clearing underlying IP rights. Third, deploying NFT programs on chains without sufficient liquidity and developer ecosystem. Early enterprise deployments on niche blockchains found themselves stranded when those chains lost developer support. The NFT market in 2026 is bifurcated. The speculative layer is effectively dead, and the utility layer is quietly scaling. For institutional allocators, the lessons are direct. The speculative cycle was a noise event. It told you nothing durable about the technology's value. The enterprise deployments that continued through the bear market, ticketing, gaming, credentials, luxury provenance, are the signal. Evaluate NFT exposure as infrastructure investment, not as digital art speculation, and apply the same revenue model discipline you would to any enterprise software bet. The NFT hype cycle is over, but the ownership infrastructure it built is finding real enterprise applications. Separating signal from noise requires institutional-grade analysis. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.